As the market opens for trading on Friday, September 5th, 2025, SoFi Technologies, trading under the ticker SoFi, is currently priced at 25.79, reflecting an intraday gain of 1.64%. This immediate upward momentum seems to validate the bullish narrative that has propelled the stock over the past year. However, beneath this surface-level optimism lies a fascinating and critical disconnect between the market's enthusiasm and the sober reality presented by institutional analysis. While retail investors are cheering the green on their screens, the consensus among top analysts points not to further gains, but to a potential downside of over 17% from its current trading price. This stark contrast between expectation and analytical reality is the central battleground for SoFi's valuation, forcing us to question whether the prevailing excitement is fully justified or if a significant recalibration is on the horizon. The prevailing belief surrounding SoFi is that it represents the future of banking, a seamless, all-in-one digital platform perfectly positioned to capture a generation that has grown disillusioned with traditional financial institutions. The company's rapid expansion from a student loan refinancing service into a diversified fintech behemoth offering personal loans, mortgages, investment accounts, credit cards, and a robust technology platform in Galileo and Technisys seems to confirm this disruptive potential. Investors have bought into this story wholeheartedly, pushing the stock up from a 52-week low of just 6.75 to its current position, tantalizingly close to its peak of 26.61. The expectation is clear: continued hypergrowth in membership, relentless product innovation, and a sustained march toward becoming a dominant force in consumer finance. The recent quarterly earnings report, which showcased record revenue of over $855 million and a staggering 458% year-over-year increase in net income, has only added fuel to this fire, seemingly cementing the idea that SoFi is an unstoppable growth machine. However, the reality of SoFi's situation is far more nuanced and complex. The very analysts who pore over the company's financials day in and day out present a contrarian view. Despite the blowout earnings and positive market sentiment, the average analyst price target for SoFi sits at a surprisingly modest 20.78. This isn't a call for a minor correction. It's a significant warning that the stock may be fundamentally overvalued at its current levels. This bearish undertone is further substantiated by a noticeable decline in investor interest metrics over the past month, suggesting that while the price is climbing, the conviction among some market participants may be waning. Furthermore, the recent news of CEO Anthony Noto entering into a significant prepaid stock arrangement on 1.5 million of his shares, while a strategic financial planning move adds another layer for investors to dissect. It's this chasm between the explosive growth story and the cautious, data-driven reality of institutional valuation that defines the current investment thesis for SoFi. Dissecting the stock's recent trading patterns reveals a high-stakes tug-of-war. In the last session, the stock fluctuated between 24.24 and 25.54, trading on a volume of nearly 48 million shares. While substantial, this is still below its 90-day average volume of over 74 million shares, indicating that some of the frenetic energy that characterized its earlier run-up may be subsiding. The stock's performance is inextricably linked to the broader macroeconomic environment. The persistent whispers of a potential Federal Reserve interest rate cut are a double-edged sword for SoFi. On one hand, lower rates could reduce the company's cost of capital and stimulate demand for its lending products. On the other, it could also signal a weakening economy, which might lead to an increase in loan delinquencies and charge-offs, directly impacting the company's bottom line. The market seems to be pricing in the best-case scenario, but the risk of a less favorable economic reality remains a significant overhang. This sensitivity to macroeconomic shifts, coupled with intense competition from both legacy banks aggressively upgrading their digital offerings and a host of nimble fintech rivals, creates a volatile and unpredictable trading environment. To truly understand SoFi, one must look beyond the stock chart and appreciate the architecture of its business. The company operates through three distinct segments: lending, financial services, and its technology platform. The lending division, its traditional core, remains the primary revenue driver. However, the future growth story hinges on the other two pillars. The financial services segment is designed to create a sticky ecosystem, drawing users in with checking and savings accounts, an investment platform, and credit services, thereby increasing the lifetime value of each customer. The real gem, however, might be the technology platform, powered by its acquisitions of Galileo and Technisys. This segment provides the underlying infrastructure for many other fintech companies and neobanks, creating a diversified, high-margin revenue stream that is less susceptible to the cyclical nature of the lending market. This strategic trifecta is what bulls believe gives SoFi a durable competitive advantage. The company's ability to successfully cross-sell products and leverage its technology stack is paramount to justifying its premium valuation. The recent launch of its own AI-themed ETF, SoFi Agentic AI, AGIQ, is a clear signal of its intent to innovate and capture emerging market trends, but the ultimate success of these ventures is yet to be proven. Comment below on whether you think SoFi's expansion into thematic ETFs is a smart move or a distraction from its core business. Looking toward the future, several catalysts could propel the stock higher, potentially bridging the gap between its current price and even more ambitious investor expectations. A continued dovish pivot from the Federal Reserve, coupled with a resilient job market, would create an ideal operating environment for its lending business. Sustained, profitable growth in its non-lending segments would also prove to the market that its diversification strategy is paying off, potentially leading to a re-rating from analysts. Conversely, the risks are just as palpable. A higher-for-longer interest rate scenario would compress margins and could stifle loan growth. Any sign of deteriorating credit quality within its loan portfolio would be severely punished by the market. Furthermore, the specter of increased regulatory scrutiny on the entire fintech industry remains a constant threat. The ultimate trajectory of SoFi's stock will depend on its ability to navigate these macroeconomic headwinds while continuing to execute on its ambitious vision of becoming the go-to platform for digital finance. In conclusion, the narrative of SoFi Technologies is a classic tale of expectation versus reality. The market's expectation is a seamless continuation of its meteoric rise, fueled by a powerful growth story and a belief in its disruptive potential. The reality, however, is a company trading significantly above its consensus analyst price target, facing formidable macroeconomic uncertainties, and operating in an increasingly crowded and competitive landscape. While the intraday price action today is positive, the underlying fundamentals present a far more balanced, if not precarious, picture. The challenge for investors is to reconcile the compelling, forward-looking vision with the tangible, present-day risks. The ultimate resolution of this tension will determine whether SoFi can grow into its lofty valuation, or if it is destined for a correction that aligns its share price more closely with the cautious reality of Wall Street's calculus.